a lot of those things benefited very wealthy people and very large companies. I feel very strongly about that. And right now, I would argue the bill is coming to do much more for smaller businesses in many ways, particularly those reliant upon bank lending. I think it's at least a decent bar bet to say that if we had let Silicon Valley Bank fail, we would already be in recession. And Silicon Valley Bank failing would be very typical of the Fed, it would be an event that you would see in the midst of Fed tightening very aggressively. And they generate a ton of cash, right? They are short duration equities, which in my opinion is what goes back to the slide I showed of the companies that don't have profits. Those are very long duration equities where you're discounting future cash, very, very distant future cash flows by interest rates. Companies that generate a lot of cash, they're shorter duration. You get more of the money back more quickly and can reinvest it at higher interest rates. So that, to me, is important. And that's why I think energy is probably the best way for the average person to hedge against inflation. Another unintended consequence of financial repression is that it created great incentives for corporate America to focus much more on financial engineering than capital spending. All right.
Okay.
Go.
All right. Well, Jason, thank you very much for joining us today.
Thanks for having me. I appreciate it.
And thanks, everyone, for tuning in. Many of you all, the subscribers to our Markets Policy Partners newsletter and viewers of this webcast, will recognize Jason from his appearances on Bloomberg and CNBC and other media. But you won't have a good reason to understand the quality of Jason's work because his firm, Strategas, provides market strategy and insights to institutional clients only. Strategas today is one of the most influential strategy research firms on Wall Street. My partners, John Fagan, Brendan Walsh, and I host these webcasts to shed more light on key factors influencing financial markets and government policy, which form the bedrock of our daily newsletter. We also like to put these current market factors into longer-term perspective, and Jason's work on the history of economics and markets draws us to solicit his views about prospects for the longer term. We're going to discuss the remarkable prosperity gains in the last 8 decades since World War II, and whether they're likely to continue or whether the many unprecedented headwinds facing the Western world are conspiring to slow or maybe even reverse that trend. Jason, let's start with these formidable conditions in the economy and what we should expect in financial markets. And what are some of the easiest predictions to be confident in?
Well, let me start. There's no easy predictions, and I think it was William Goldman, was a producer in Hollywood, said no one knows anything. I don't know if you, and I very much subscribe to that idea, but you try to put, the way we do our work is we do a lot of work, we put a lot of charts and data out there, and then we try to essentially play the odds. And so I'm just going to show you what I think is probably the most important chart that I think is would be difficult to escape in terms of a forecast. And this is, I don't know if you guys are seeing this, but this is the idea of interest expense is likely to be a much greater portion of the budget and the deficit, and the idea that, in my opinion, this is pretty inescapable unless the Fed decides to do another round of quantitative easing, which is possible, but I think is inconsistent with the idea of fighting inflation. So what this chart is showing is that while a lot of corporations and individuals who obviously don't have the ability to print their own currency tended to borrow money long, Uncle Sam borrowed it short, right? So Uncle Sam basically took out an adjustable rate mortgage on its future. And so we have $33 trillion in debt total, about $26 trillion in debt that's owed outside the government. And a third of that matures in the next year. the cost of all, the weighted average cost of all of our debt is about 3%. And so if you look at 10-year treasuries today, which are among the cheapest part of the curve for the borrower, 490 is a lot higher than 3%. So the interest expense is going to explode again, unless the Fed buys more treasuries. And so that's going to crowd out other, it's going to crowd out other spending. It's either going to crowd out other spending, or the next president, whoever that is going to be, is going to have to make some really tough choices, or they're going to have to just accept higher inflation. But if you look at this chart, the blue line is net interest costs as a percentage of tax revenues. And right now we're at about 14. In the past, when you got to 14, countries would generally focus on some level of austerity. I think it's going to, I don't find a lot of profiles in courage in Washington on either side of the political aisle. And so there's no easy bets, but I think interest expense exploding, I think, is a pretty good bet. I think that also obviously leads to higher long-term interest rates and more political volatility and probably lower multiples. So that's the easy. I don't want to say it's the easiest, but it's the one that I find hardest to argue against. This is really just kind of more in the math category.
That one of the ways that governments have historically gotten out from under high degrees of debt has been financial repression, where they hold rates well below inflation to debase the currency. And you know, what are the prospects of that? After World War II, the Fed seemed to be highly cooperative with the federal government. That doesn't seem to be the case, at least by rhetoric today. How do you think that gets resolved?
Right. So in World War II, we had World War II. The Fed was largely almost a department of the Treasury Department. It was definitely definitely subservient to the Treasury Department, and the decision was made to fix interest rates. So bills were fixed, I think, at about 38 basis points, and 10-year Treasury yields were fixed at 210. Regardless of what the inflation rate was. So as you would imagine, that was actually a terrific period for stocks. In the same way QE is a terrific period for stocks. The question is now, what is the political tolerance for higher inflation? And in my opinion, that's what's different this time, is that I think if you looked at the midterm elections last year, it seems like an eternity ago, but inflation was one of the top 3 issues that people were talking about. And it seems to me that, especially with this Fed, it's unlikely that they're going to engage in another round of quantitative easing without some sort of financial accident. So I think the binding constraint is the fact that the people want inflation to be lower. But I was going to show you before, in terms of what was happening this year, it's hard to be pure. People can talk a big game about this stuff until something goes wrong. And so this shows you the S&P 500 year to date, cumulative year to date. And what it shows you is that actually the S&P 500 was flat until Silicon Valley Bank failed. And then as soon as Silicon Valley Bank failed, the market took off. And why did it take off? It took off really for 2 reasons. One is the Fed flooded the system with liquidity they added about $400 billion in assets to their balance sheet over 3 weeks. And then because of the debt ceiling, we stopped issuing debt, but still continued to spend money. So we drew down our savings account by $600 billion. So in my opinion, this is largely what has been driving some of the beta rally that you've seen this year. The only problem with it, of course, I mean, if it worked this way, we would just do this all the time. We just print money But the problem, of course, is that it results in higher inflation. And so, Bob, I don't know, maybe we'll just accept that. But I think it's not going to be as easy, especially with this Fed. The next Fed may be more Arthur Burns-like in terms of their relationship with whoever the president may be. But I think this Fed is actually pretty independent, or trying to be pretty independent.
Yeah, I suppose that both of these factors also contributed to corporate earnings holding up better than people were expecting.
Absolutely. I mean, of course, it's hard to know, right? And the thing about our business, right, is that it's not a hard science. It's not like physics or chemistry, or it's a social science. And so you can't run the same experiments over and over again and expect to get the same answer, because things are so different. But I think it's at least a decent bar bet to say that if we had let Silicon Valley Bank fail, we would already be in recession. And Silicon Valley Bank failing would be very typical of the Fed. It would be an event that you would see in the midst of Fed tightening very aggressively, right? So the issue is that we didn't allow it to fail, and we could debate whether that's a good idea or a bad idea. That was a good idea or a bad idea, but it gave us a second lease on life, if you will, in terms of the business cycle. Kept corporate profits higher, allowed consumers to spend more money, but eventually the bill comes due, right? I mean, there will eventually be some point at which you have to pay that back, and I think the fact that inflation is still relatively high, even though it's come down, means that at a minimum, short rates are probably going to have to stay higher for longer.
One of the curiosities in this case is the Federal Reserve is fighting against inflation at the same time the federal budget deficit is massive. And generally, historically, that's been very simulative. So you have one part of the government putting the brakes on, another part of the government putting the foot on the accelerator. That also seems to be a condition that is hard to anticipate how that's going to change.
Amen. I'm of the view, for whatever it's worth, that the anomaly was 0 to 2% inflation. That the more typical, kind of area of inflation is more like 3 to 4. In the post-war period, the average inflation rate's been about 3.5. But I feel very strongly that it's going to be very difficult to get back to the Fed's target of 2%. As a matter of fact, I think it's going to be so difficult that the Fed, after another couple of months, if they can keep inflation at 3%, I have a feeling that they'll declare some sort of victory and not tighten any further. But as you're pointing out, I think there are structural reasons why inflation is likely to stay higher. And as you pointed out, the Federal Reserve in many ways is fighting the federal government. We are running budget deficits persistently now of 5% plus of GDP. That is unheard of in a period in which you're at full employment and you're at peace, at least for the time being, right? So this is extraordinarily unusual. Now, so a 3.8% unemployment rate, the budget deficit shouldn't be anywhere near 5%. It should be like 3 to 3%, or something quite a bit lower. So God forbid unemployment rate picks up in any sort of meaningful way, the budget deficit's going to explode just because of all the automatic stabilizers, unemployment insurance, food stamps, welfare, all of those things. So we're not starting from a great spot. And we also have a fair amount of money from the Inflation Reduction Act, so ironically named, and the CHIPS Act that has yet to be spent. So that is going to be a challenge for the Fed, it seems to me.
Yeah, they may be able to just leave interest rates where they are, and that would be the financial repression as inflation roars higher.
Yeah, it may, and again, you may just accept, just as a matter of life, the fact that inflation is more like 3 to 4, and that works, except that as we point out here, 65% of the federal budget is indexed to inflation. So Social Security, Medicare, Medicaid, veterans benefits. So it's a little bit of a fool's paradise to think that you can really kind of just wait it out, because inflation continue, time waits for no man, right? And the expenses on this extra spending continue to tick higher. And the other reasons I have on this page, I won't go through the chapter and verse, but the two that I think are very important are number one, which is the idea that I do think that the era of deglobalization, or of globalization rather, is over. I mean, I think that it was a very special period after the Berlin Wall came down, and then after China joined the WTO, we were able to have very complex, very long supply chains, very able to arbitrage input costs. I think for a variety of reasons that's over, but it's largely because China, one of the few things Republicans and Democrats can agree on is that China is largely seen as a threat at a minimum. And so there's a much bigger focus on bringing supply chains closer to home, shortening them up. And then the other thing I would say, and I don't want to offend anyone's politics, but I do think our environmental policies, generally speaking, are not consistent with lower energy prices. And you put all these things together, it's pretty hard to get to what some economists are calling the last mile of getting inflation from 3% to 2%.
There's been a lot of talk about how the Fed is going to try to, you mentioned that the Fed is going to try to declare victory of some way, shape, or form, or at least like quietly, not concede defeat. So what do you think this, how do you think this really takes shape? Do you think it really is, the Fed just sort of starts to make distinctions, core versus they start focusing on some sort of narrow, but you don't think they're actually going to change the inflation target, or do
no? I think I feel strongly that would be, that would be bad. I think that would be and I think they at least have to keep up the illusion that they're trying to get to 2, or I don't say illusion, but the idea that 2% is kind of the goal over a long business cycle, over a full business cycle. But I'm very doubtful that they're going to say the new target's 3. And if they did say that, I think that would not be a particularly great development certainly for the fixed income markets, right? So I think that's why they're going to at least try to keep up appearances that they're focused on 2, but it's too harmful to pursue 2 at this time. If you look at the Taylor rule, the Taylor rule would tell you to get 2% inflation, you'd probably need something, Fed funds rate that's above 8%, right? So it's just too painful. I think if the Fed really wants to, the Fed also, it has to play a little bit of politics to stay out of politics, if that makes sense. It can't be completely naive to the political realities of what would happen to their power if they raise the Fed funds rate to 8. There's a decent chance it would become a department under the Treasury Department again. That type of thing.
Yeah, so, and going into an election year, that
going into election year, yeah. So I don't.
Auspicious moment.
Yeah, yeah, precisely. And there's a populist angle, John, as you know, to politics on both sides, right? So both from the left and the right, which means that there'd be certainly both candidates. Well, I don't think would be shy. Both the leading candidates, at least for now, I don't think, as we know, would be shy in trying to beat the Fed up if they thought it was tightening too aggressively.
Yeah, I want to. I know you said before you don't want to get too political, but we're based in Washington D.C. and that's the lens.
There's nothing we can do about it.
I mean,
we're all in the same boat, right?
The kind of classic trope is, the Republicans are the fiscally conservative, and obviously we've seen a lot more, sort of spending discipline that, in the cynical world of politics, that obviously depends on kind of whether the president is a Democrat or Republican. And so when
Right.
you get Biden in the White House, they find religion again on the fiscal deficits. But the leader of the party is former President Trump, and he is definitely not singing from the same hymn sheet as a lot of the rest of the GOP caucus here in Washington, D.C. In some remarks he made a couple of weeks ago, he mentioned in an interview that he thought interest rates were too high. And, the quote was something like, nobody can do anything, nobody can buy houses. And we haven't really gotten into what his policy platform is going to be, but one might imagine that it's going to look kind of like his policy platform from 2016, which is, low taxes and so forth. So there certainly doesn't seem to be a lot of fiscal rectitude. He's also broken with elements of the party in terms of reform on entitlements. So there's a strange dynamic there. I was wondering if you could sort of comment on how you see that playing out, the dynamic between the two parties playing out on that front.
And listen, I would say that's I'll circle back to President Trump in a moment. But I can tell you just I'm very friendly with some Republican senators, and who will be very, very candid in saying that it's hard to get a lot of their caucus to really see deficits as a problem until it's a problem, right? So, and that's on the Republican side, right? So on the Democratic side, I would say it's even seen as less of a problem. The only thing that gives me hope, I would say, and I personally do think President Trump is right on some. On the spending, I disagree. He has in the past at least surrounded himself with people that I think understand these dynamics well, whether he listens to them or not. Stephen Moore or Larry Kudlow, both of whom are friends of mine, is another story. But listen, I don't think you're finding a lot of profiles and courage on spending in Washington on either side of the aisle. And as I said before, in terms of the debt, the bill coming due, there's really kind of only, as I said, there's only really three ways out. I would say one is to inflate your way out. The other one is to actually do some sort of austerity. And the third one is, I don't want to discount it completely, but you could really try to grow your way out through productivity, big productivity gains.
And they'd have to be big.
They'd have to be really big. And I'm not, I don't think Ozempic is big enough. And I don't think, I don't think AI is shovel ready, right? I mean, I think AI could be something that helps out a lot in the long term, but it's not something that's going to relieve our issues in the short term. So, John, I'm with you. I wish I could be more optimistic, but I don't see a lot of deficit hawks really anywhere.
So if we
on
think
either
about
side.
the evidence would suggest they've been right for a long time, that nothing yet has really broken. We've been able to fund ourselves this way. Everybody on the other side, fiscal hawks, all say, well, it's all going to go wrong sometime, and you just don't want to keep spending money. When's it going to go wrong? What do you look for that?
It's long-term interest rates. It's what we're seeing. We're in that of it now. And I would say, I don't want to be ageist about this, but there's an awful lot of people. I'm older, so but I know a lot of guys I work with and a lot of clients who have big jobs and are maybe 40 years old and manage a lot of money, and they've really never known anything other than financial repression or quantitative easing. So the idea that you can have real long-term interest rates of 2% seems crazy to them. But as a matter of fact, that is the long-term average, right? Is about 200 basis points. And it seems to me, Bob, we are not, we're running twin deficits right now that are among the highest in the world. Our trade deficit and our fiscal deficit are really only behind India and Italy. And we have the reserve currency, so that's a big chip in the game. But it's not, first of all, it's not a divine right. There have been many countries that have had the reserve currency throughout time. We're not in any imminent danger, I don't believe, of losing it, but we are in imminent danger of there being a big political problem because of higher inflation and higher long-term interest rates. And I think that's playing out, kind of as we speak.
Yeah, I think that's a really important point because, I mean, we talk about Wall Street and, traders and things like that, but also just if you run a pizza shop or, you're the CFO of Microsoft, you've never in your career really had to deal with rates at this level. So we have just a kind of a lack of expertise throughout the country of how to borrow money at rates like this and run a business in this new reality.
Yeah, you make a great point. And this is one of these things where why part of the reason why I think there is a populist strain throughout our politics is that I feel very strongly that quantitative easing and a lot of and quote unquote free trade, which I wholeheartly believe in free trade if it's really free. To say that, but I'm skeptical that the relationship we had with China was truly free trade. A lot of those things benefited very wealthy people and very large companies. I feel very strongly about that. And right now, I would argue that the bill is coming due much more for smaller businesses in many ways, particularly those reliant upon bank lending.
Yeah.
Right. Because, bigger companies or companies of a certain size, they have access to the capital markets. You have a very deep private market right now, so on, which it doesn't absolve anyone from having to deal with higher interest rates, but it can give you more time. But your average small business is very dependent upon bank loans. And I wanted to show you this chart because this is one of the things that makes me a little bit worried about the economy, the small businesses. This red dashed line here is banks tightening lending standards.
Yeah.
And the blue line is unemployment. And, generally, as you can see, there's kind of an echo, right? Once one rises, the other one rises a little bit later. And again, it's not working perhaps as quickly as we would have thought it would be working, but there's no doubt in my mind that it will have an impact. And I think, as you're pointing out, one of the big problems with quantitative easing for 12 years, I almost can't say enough about how bad an idea this was, is that it's absolved anyone from thinking about risk in any sort of meaningful way, particularly policymakers.
Yep.
Right. I mean, they're of the view there's no constraints on spending. So what's the problem? Now, if you remember James Carville many years ago, in '94, he said, if I'm reincarnated, I want to be reincarnated as the bond market because that scares everyone. Right. And there was a certain sense because when President Clinton came in, they had a very, very, very ambitious domestic agenda. But the bond market basically said no, or the people in the administration that were on the economics team said, you can't do this, all the things you want, because the bond market's going to balk at it. That hasn't had, in the Obama and really, I mean, certainly during President Obama and President Trump's and to a certain extent, President Biden's term, that has an issue. Now it's an issue. The implication of that, I do think, is that, especially if you're a little bit younger, is I think you have to, manage your expectations in terms of what the capital market returns. We all have to. But, I mean, there's been a long time. You've had a period where you've had multiple expansion for years. And single digit types of returns are seen as like a thing of the past, but generally speaking, over long periods of time, the stock market rises at a level commensurate with profit growth, which over the long term has been about 7%. Right. So I would just say from here, if you think there's going to be higher interest rates and higher inflation, which I do, that are more structural, it just strikes me that it's going to be hard to get that multiple expansion, and that market's going to rise in line with profits.
Yeah, the Apple bonds yield 5% now, but their dividend is 50 basis points. So
right.
there's new things that you as an investor can weigh. Where you're going to put your money. Before, if you wanted anything above zero, you had to put it in equities.
Absolutely. I mean, that's another thing that was very regressive about QE. Right, is that if you weren't rich but a saver,
yeah,
you just had a savings account, but you weren't rich enough to have a deep stock or bond portfolio or private equity or venture capital or Bitcoin or, you got kneecapped. You got zero for 12 years. And so, but you're right. And so at that period of time, I wrote an op-ed for the Wall Street Journal in 2013 called Tina, about the idea that there is no alternative in a world of QE. And now there are many, now you're absolutely right, Brendan, there are many alternatives for people that want to protect themselves or get some yield. They don't have to take as much risk to get something.
Yeah.
And
yeah.
one of the things that we've seen, one of the hallmarks of the equity market in the post-global financial crisis, the QE era, has been that growth just mopping the floor with value. The knock-on value is, it's hard to get absolute performance, even if they outperform. If you get, this kind of controlled demolition of the, high-flying tech stock valuation. I borrowed that, by the way. There was somebody characterized the Fed as conducting a controlled demolition of asset prices, which I thought was
good luck.
Really
good luck on that.
But do you think that when you look at the coming years, the medium to longer term, is it possible that value stocks finally start to shine and actually have some performance, or are they just going to fall less than the rest of the market?
Well, so it's a good question. So I think, so in a bear market, everything declines, right? So I mean, value will outperform in a bear market because it declines less. But I do think, to the extent to which this is a new era that is going to be a more traditional era, it seems to me, in terms of access and cost of capital, access to and cost of capital, that value can absolutely outperform. And a lot of it starts with the valuations that you're starting with, right? And I want to show you something here, show you a chart. But one of the things that has been a byproduct of QE is that you obviously have a lot of companies that can rely on the kindness of strangers to grow, right? And so if you look at this little table here, this shows you the percentage of companies, these indices, that haven't earned a profit in the last 12 months. Okay, so if you look at, Russell 2000, this is true for all small caps, but if you just look at the Russell 2000, but also growth and value too, there's a lot of companies that haven't had a profit. And you can do that when the cost of capital is zero, or in real terms, or negative in real terms. When it's positive in real terms, that's a lot harder, right? So there's always a percentage of companies that don't earn money, biotech or something along those lines, but a lot harder. And just say, keep trying stuff, and something will work, and you get bailed out. I don't think that's going to be a reliable business strategy moving forward. It's going to be a lot harder to do that.
Just as you were flashing through the slide that you had, couldn't agree more about your list for the drivers of structural inflation. And obviously geopolitics is behind a lot of those. But this is the one you're talking about. Just a quick question on that before we go.
Yeah.
Some of them were like the reshoring, higher, basically the pendulum swinging back toward labor, and having that sort of thing. Environmental policies, elevated energy prices. Are these, in some ways, looking at these through the lens of, creating more structural inflation, obviously kind of negative, but each one of these you can, well, maybe not number two, but a lot of the others you can kind of look and say, well, maybe there's a trade in here. And, like the reshoring, industrials.
Absolutely.
Right.
No, it's, and again, this is, I would argue, that financial repression, another unintended consequence of financial repression is that it created great incentives for corporate America to focus much more on financial engineering than capital spending. because you were able to issue cheaply, buy back stock, and it became accretive to earnings. And so, again, very good for management, very good for shareholders, but not so great for the average guy. I think now that's going to be harder to do. The good news is that that could actually spur even more innovation, maybe innovation in other places aside from Silicon Valley, and which is terrific. But it would be nice to see it in other parts of our life. And I also think that in terms of, again, talking about, for lack of a better term, the average guy, the worker, I'm of the view that labor is probably due to get some of what they gave up back. And this is a chart that shows you that the solid line is corporate profits as a percentage of GDP, and the red dashed line is labor share of corporate GDP. And all of these charts are, they can become like Rorschach tests for people. People can see anything they want in them. But what I see is that the big statistical break, aside from the global financial crisis, if you kind of took that out, but the big statistical break in this series really happened when China joined the WTO. And we essentially offshored a lot of things that maybe we didn't have that many comparative advantages in, but we did it so quickly that we didn't allow a lot of skilled workers or people that didn't necessarily have a college education to retool themselves. And I think to the extent to which we're going to focus more on infrastructure, we're going to focus more on onshoring. To me, that first of all, that could be good for American workers, could be good for the United States. And I do think it probably does make some sense given the geopolitical realities that we do make things closer to home. I think it's probably that's out of my lane, but it's not perfectly competitive, but it's probably an acceptable trade-off, given the realities of the world we're in right now.
Jason, it was the Kryptonite slide 19.
Oh yeah. So yeah, people love the word Kryptonite. I know I do. Yeah, but this is, this just shows you the average PEs by inflation tranches back to 1950. And as you would suspect, the closer you get to zero in terms of prices or price inflation, the higher the multiples are, right? Because interest rates are lower and you're discounting future earnings by a lower discount rate. And the issue, though, I would say, is that there is a meaningful change here. Once you get over 4, the world changes pretty meaningfully for stocks. The sweet spot is 0 to 2. 2 to 4 isn't bad, right? But you get over 4, bad things really start to happen. And I would say, we've been in the financial repression era, we've been hanging out in the 0 to 2% range for a long time, for 12 years. And now, I kind of am in the view that it's in this range. I have people coming back at me, my clients, institutional clients, say, well, the world has changed, the companies are different. But I'm not particularly swayed by that. It's hard to suspend the laws of financial physics. Ultimately, present value of anything is the future cash flows discounted by some sort of interest rate, right? So even if it's a much higher margin company, those laws still apply, right? So they may be able to trade at higher multiples, but higher interest rates definitely present an issue in terms of what the valuations are ultimately going to be.
Yeah, this slide might also be done with real rates because this isn't taking into account what the cost of money is.
That's right.
And that's sometimes a reflection of CPI and sometimes it's not. but
Well, that's
that
right.
would be even starker, I think.
Yeah, no, it's a very good point. I mean, I think that there are other reasons too. Just to finish the loop on reasons why I think 10-year Treasury yields are likely to be higher. We discussed the idea of just more supply. We discussed, I think, the idea of the typical spread between the 10-year Treasury yield and inflation is about 200 basis points. So that would tend to lead you to believe that 5 to 5.5 isn't that unreasonable. But it also seems that there are circumstances outside the United States where countries or foreign lenders are either unable or unwilling to buy as many treasuries as they had in the past, right? So Saudi Arabia is making a conscious decision. This is true before the events of the last several weeks, to diversify its foreign currency holdings and buy other paper. China is slowing, so it doesn't have as many currency reserves with to buy our treasuries. And then Japan is talking about abandoning yield curve control, and long-term rates are higher there. So they may have fewer reserves to pump into treasuries as well. So there's a number of reasons to think at a minimum that we're going to go back to a more traditional, I think, relationship between inflation and long-term interest rates, that you can't rely on 0% real or very low real rates indefinitely.
So how about next 5 to 10 years? What do you think all this means for this prosperity boom that we've enjoyed for so long?
Yeah, I mean, I think in terms of the big picture themes that I believe deglobalization is a big theme. I think that's going to be with us. And I take no pleasure in saying that. I think it certainly is great for business, but I do think the world is you could say devolving into different spheres of influence. It's becoming a more multipolar world as opposed to a single pole, which was the United States. And so that's going to drive up the cost of business. I do think that's going to lead to lower returns, generally speaking, from financial assets. I think that's important. I do think also from an asset allocation perspective, as we discussed, value has a better chance of outperforming growth, just given where we're starting as far as valuations. And then I also think that this love affair that many fiduciaries have had with private markets, given what I think about interest rates and inflation, is going to be less exciting. To say, I think the returns from the private markets will be far less enticing. Those markets really feed on low interest rates, right? They're levered long vehicles, so they do extraordinarily well in periods of long interest rates. There may be a certain sense in which long-short strategies, more traditional hedge fund strategies, do better because the dispersion of returns between good companies and bad companies tends to be a bit wider.
Yes, and they're swimming upstream for poorly managed companies. When your cost of capital is high, it's faster. Right. The truth comes at you faster.
Yeah. I mean, during the QE era, I mean, and of course, no one likes to see companies fail, but it is part of a free market system. I mean, that's how the creative destruction, that's kind of how it works, right? It's really, I can almost only think of Sears in that 12-year period. I'm trying to think of large company failures in that period are almost unheard of. And again, that's not generally how it works most efficiently.
Jason, one of the things that strikes me as likely is that the confidence in the financial system can wane pretty quickly when you've got all of this debt, and that things that manipulations by governments, et cetera, just bring to a head a lack of confidence in the money supply. Back when in the early 2000s, I had a friend who was a gold bug, and he taught me all about what Greenspan had launched and Easy Money and how much credit expansion there had been and how far beyond the normal credit we had moved. I'm wondering whether blockchain and CBDCs and Bitcoin and alternative methods of moving financial value around the world might be something that becomes a bigger issue if the old monetary system confidence in the old monetary system starts waning.
No, listen, I think the appeal is obvious to me, right? Because while the U.S. may is likely to maintain its reserve currency status, simply because it's being bailed out by its competition, other fiat currencies. I do think the dollar's been very strong this year versus other fiat currencies, but it's been pretty weak versus a gallon of gasoline or a ribeye, or so you're losing, depending on what the other side of the trade is. It hasn't been so great, and I can see how people would want to diversify some of their wealth in other currencies. The big caveat, I would say, as far as cryptocurrencies, is that I feel very confident that political elites are going to try to control that they're not going to allow there to be a parallel currency that competes with policymakers in terms of collecting taxes or conducting monetary policy. And there's if you look at the statements on this from Janet Yellen to Larry Summers to Ken Rogoff, I mean, frankly, Ken Rogoff, if it were up to him, he'd abolish cash, physical specie, right? So the idea of having a Bitcoin or something, I think would be way off the reservation. So it seems to me there'll be more of a tendency for countries to want to completely control crypto, as you pointed out, through central bank cryptocurrencies. And that will bring up other issues in terms of privacy, in terms of freedom. I'm not quite sure how it'll turn out, but that will not be an easy fight for governments, at least in the United States. I can't see that being something that's widely embraced. It does lead me to believe, as I'm showing you on this slide, I'm pretty bullish on commodities or harder assets because of all of the things that we talked about. I think people will view hard assets as a hedge against fiat currencies. So that's one place where I think there's some opportunity.
I hope this question isn't too off the wall, but talking about the way that the government and from the Fed and into the regulatory space are in a mano a mano grappling with markets. One of the places we've talked about crypto regulation, we've talked about debt and deficits, trade, and sort of reshoring, countering China, that sort of populist impulse, building up infrastructure, and so forth. One of the policy areas that is definitely getting more prominence, but is clearly a work in progress in the U.S. is antitrust. I'm interested to get your thoughts on that, because there are arguments on both sides. Obviously, you can make a market market-friendly argument for antitrust, and the idea of unlocking value that the sum is worth less than the value of its part, and some of these companies that could be individual stocks are embedded in these gigantic conglomerates. Who wouldn't want to invest in YouTube, something like that. What are your thoughts on this?
Well, it's a really good question, because I very much like to consider myself a supply side person, very much of a free market person. And so I'm somewhat conflicted, at least in the current administration. I have to say I'm somewhat conflicted, not entirely, but because I do see the importance of antitrust legislation and the Sherman Act and trying to avoid monopoly power. I sometimes wonder whether those principles are applied to the wrong companies, that you know they're searching for companies that they can break up as opposed to ones that maybe have too much power. I do think this idea of the Magnificent Seven, my own opinion is that one of the greatest risks to these companies, they are expensive, but they do have a lot of cash. But one of the greatest risks to these companies may be regulatory. In that, and there's a reason why Jeff Bezos bought the Washington Post, right? I mean, and there's a reason why Tesla owns X, or you know, Elon Musk owns Twitter, right? I mean, there is these companies for the most part. Again, I don't want to get too conspiratorial, but we're largely off the radar of regulators for a long period of time. And that's largely because the rate of technological innovation was so fast that the markets would generally take care of it on their own. The innovation could render companies, you know, the whole list of Xerox, Hewlett Packard, you know, companies that seemed IBM seemed unbeatable became very beatable just because of the march of time and innovation. You know, in today's world, it's harder to see that because these companies truly do have quasi-monopoly power, and it's hard to see things that will displace them. It's, you know, it's hard to see another Google. They're the huge first mover advantage, or Amazon, or Apple may have less, in my opinion, might have less monopoly power than some of the others. So I don't know if I'm answering your question, but I do think that at least that is, if someone were going to say to me, I wouldn't short any of these companies, like if you put a gun to my head right now, you know, to be honest with you, because they're just too strong, have too much cash. But if somebody said, you know, what's the risk there? I would say that the risks are, one is that they're pretty expensive on a relative basis, and the other risk is a regulatory one with regard to antitrust.
One thing I think about on the antitrust thing is that I think that the Sherman Antitrust Act is too limited if what we're really trying to do now is prevent companies from having too broad a power, because the argument that customers are being harmed by these companies is a very difficult one. Because if you look at the net good that they've provided, the tools that they've delivered individuals to live better are pretty compelling. And so you have to look more broadly at where the problems are. I think that's part of the reason that it's been difficult to dismantle or to attack these companies, is that I think different legislation.
Yeah, Bob, it's an interesting point, and I'm also not a libertarian, right? So you bring up a great point because it seems obvious that because all of us as human beings, we're consumers, but we're also human beings, and there's other things going on socially that these companies have cast a wide shadow on, where they do have monopoly power on certain, not just commerce, but just other methods of communication. And it's kind of hard to believe some of these things are not particularly well regulated, in my opinion. And I say that largely as a parent. And you know, I look at some of the power that some of these companies have and the impact socially they have, and it's a very, very, as we can see, it's a very tough issue, right? I mean, you know, where do you, very, very hard to, you know, it would be better probably to, in a perfect world, to just leave it completely alone. By the same token, it doesn't quite seem like the right answer to me either. You know, or maybe something has to happen that maybe self-regulation. I don't know, that might limit some of their power.
Jason, I guess as a student of history, what should we expect, or what has traditionally happened when the world enters? I just look at the last 6 weeks, and it just seems like the geopolitical situation has materially changed.
Right.
And that you look at risk assets, and it looks like they absolutely do not care. Equity market in particular. I'm just very surprised by that. And
Yeah, you and me both. I mean, I think that, but I do think, you know, the I would say the wheels of justice may turn slowly, but they turn, right? And I think and we have to remember that, as we talked about before, the monetary policy is largely set up these attitudes and these set up people's expectations for a long period of time. So it's going to take a long period of time to develop other attitudes towards risk, right? Because right now there's a general feeling that there's an enormous Fed put out there, and I would say people are right. I mean, you know, there's not a lot of evidence to the contrary, as we said before, even with Silicon Valley Bank earlier this year. You know, it seems to me we largely de facto guaranteed all the bank deposits in the country, right? So, it's just I guess, Bob, the best thing I can say is it just might take time.
yeah,
Yeah, you know, is that it's hard for people have a strong we all have a strong recency bias in terms of risks and return, and it may take time for us to realize that this isn't as benign a financial environment as we've had.
Yeah, I guess it could also, you could really, the markets could also be saying the risk of something in the Middle East, a war in the Middle East, and the war in Ukraine, and any other things that, like Azerbaijan right now and other areas that start heating up, their ability to impact the U.S. economy is still very limited.
That's probably
and that might be true. I mean,
yeah, I think it's a good question. I think particularly the from a very bloodless point of view, right? A very cold point of view, which is hard to do, just separating out the humanity of it.
Yes.
I would argue the U.S. is extraordinarily unique because economically it has everything. It's awash in natural resources. It has a great university system, great innovation. It has very deep capital markets. I mean, it's you know, it's almost perfect. You know, I would, the biggest
another element of perfection, and that is its geography. It has two oceans.
Right, precisely, right. So that's why I think some of the energy policies, I would argue, seem counterproductive, because we're not using a major advantage that we have, right, that could isolate us further from some of these issues, at least these economic issues. You know, right now we're allowing, I would say to a certain extent, we're allowing, through our own policies, we're allowing some of these economic issues that don't need to be economic issues to affect us. So, and that could change very quickly in a different administration and so on. So, I don't want to go too far down the path there, but I think you bring up a good point.
On the hard assets slide, what are the easiest ways for people to invest in those hard assets? What is that a chart of in particular? Is those equities of basic materials companies?
No, these are actual hard assets, but the equities are very, for the average person, the equities will be a very good proxy for this. Matter of fact, they'll probably be better in a way because they're somewhat leveraged. But believe it or not, the best commodity that in the studies I've done, the best commodities I've seen in terms of hedging against inflation in kind of the modern era has been energy itself.
Yeah,
has been oil, and so I personally believe that energy stocks are very attractive given the current regulatory environment that we're in, given the capital discipline of the companies, which is unusual. Companies not usually known for capital discipline, you know, for really since I've been alive. But you have a lot of things conspiring to make those very interesting investments, it seems to me, and they generate a ton of cash. right? They are short duration equities, which in my opinion is what goes back to the slide I showed of the companies that don't have profits. Those are very long duration equities where you're discounting future cash, very, very distant future cash flows by interest rates. Companies that generate a lot of cash, they're shorter duration. You get more of the money back more quickly and can reinvest it at higher interest rates. So that, to me, is important, and that's why I think energy is probably the best way for the average person to hedge against inflation.
Jason, do you like tips? Have you spent much time looking at them?
I haven't spent much time looking at them, but it seems to make some sense to me. I mean, but again, I'm hardly an expert, but my own particular feeling is that it's more likely rates and inflation will go up further from here than down. And one of the studies that our chief economist, John Rissmiller, performed here is he looked at all the periods of time or the last couple of 100 years in which inflation broke 7% in a variety of different countries over different time periods. And what he found is that in about 90% of the instances, you had an echo wave of inflation.
Yeah.
That you just didn't have one experience with inflation over 7. Usually a couple of years later, you had another instance. And in the 70s, of course, we had 3 waves of inflation.
It sounds like he sent that to Jerome Powell about a year ago.
Yeah.
I really think that's what he's doing. He really worries about an echo.
I think, and I think he should. I'll show you this chart. I mean, this is the CPI in the 70s, mid 60s through the mid 80s, but you can see here, it was a combination of bad policy and bad luck, I would argue, right? I mean, we went off the gold standard. We spent a lot of money on Vietnam and the Great Society. And then you had bad luck and you had 2 oil shocks, right? So, and you put those things together and you see that the Fed had to fight inflation 3 times, each at successively higher rates of inflation, right? So so you fought it at 6, then you fought it at 12, then you fought it at 15. And then when you have to fight it at 15, it's really painful, right? It really is very tough for.
Yeah, you need Volcker.
Yeah, you need someone that's really just
a strong guy.
Good door. Yeah.
And I think your chart on World War II shows the same thing. There was a lot of volatility and inflation during the late 40s.
Yes.
I think it was productivity that wound up. It was both the devaluation of the dollar, but it happened relatively quickly, about 5-6 years. And I think productivity was a real saving factor back then, wasn't it?
Yeah, I mean, I think you have to remember too. There was very little of the world's productive capacity that was left. I mean, the U.S. really got to run the table economically for a good 20, I mean, at least 20 years, right? Where we were really the only game in town. And so we could make up very quickly our debts from the war. And then we exported capitalism, right? We exported that globally. So we had markets for our products. And so it's obviously a tragic event, but it was very much worth the cost, the economic cost to do what we did in World War II. We were able to make up those debts more quickly. Here, I think it's harder for obvious reasons, right? It's just there's a lot more competition for capital and so on.
This was awesome. Great. Jason,
All
thanks
right.
so much. Good to see you.
Jason.
All right.
Thanks,
Take
Jason.
care. All right.
Bye.
Bye-bye.